Well, good afternoon, everyone. We'll get this thing kicked off. We are covering real assets, how to avoid fake assets, and are they still a powerful diversification play? I think we're talking about real assets there. I'm not entirely sure, though. It's not really that well written, is it? So we'll do introductions real quick. Again, Tony K with ANCO. You just heard from one of my colleagues, so I'll spare you the marketing spiel here, but I'm based just down the road in I-30 here in Dallas, and we're headquartered in Orlando, Florida. And I'll let you all.
Thanks, Tony. Good afternoon, everyone. Jay Steigerwald, President, Head of Distribution for Ashford Securities. We are in Addison, Texas. I reside in Highland Park. It's nice to be with you.
Hello, I'm Christy Garr. I'm a Managing Director with Virtus Real Estate Capital. We're an Austin-based private equity real estate manager. We have about $2 billion or so under management today, and we focus on what we consider cycle-resilient real estate. So those areas include workforce housing, healthcare, education, and self-storage.
Good afternoon. David Grumhouse, I'm President and CIO of Duff & Phelps Investment Management. We are a $12 billion AUM asset manager based out of Chicago. We focused on real assets, in particular global listed infrastructure and real estate.
And I'm Paul Nolan, Executive Vice President and Head of Acquisitions for L&B Realty Advisors. We're based in Dallas, and we're a $10 billion real estate-only asset manager.
Well, good. Why don't we start with the top here and maybe put some parameters around definitions. So let's start with the definition of real assets. And David, maybe I'll start with you to define real assets for us. And if you want to take a shot at telling us what fake assets are, you're welcome to do that too.
Well, I'm not sure about the fake, but let me try and start with the real. When we think of real assets, we think of real estate, global listed infrastructure, commodities, natural resources, and inflation-protected debt. Each of these asset classes either are physical assets or they own businesses that own physical assets. What we like about these businesses and the characteristics is they're often regulated, they're monopolistic, they're hard to replicate, and they tend to be very much fixed assets, high fixed cost assets, businesses, and businesses with high return on assets. We also think they offer really good inflation protection, usually because they're backed by long-term contracts.
Well, good. I think that's a great segue, good starting point. And David, I think you hit on a key characteristic of real assets at the end there, and that's the inflation protection. So maybe, Jay, we'll start with you with the hospitality focus. I think unique attributes that maybe help protect investors against some of the inflationary forces out there. So can you speak to that?
Yeah, sure. So Ashford's a top 5 owner of both Marriott and Hilton hotels in the United States. And one of the beautiful things about investing in lodging is that I can adjust my rates every single night. And my costs are relatively fixed. So if I charge you $200 for a hotel room tonight versus $400, that extra $200 falls right to the bottom line. So the ability to adjust rents on a daily basis can create a very bullish scenario in an inflationary or rapidly rising interest rate environment.
Great, thanks. And Paul, just if you can round that out for us, I know you do some interesting areas within real estate, cold storage, some other unique kind of sectors of the real estate market. Maybe talk about how other real assets can protect against some of these inflationary pressures that we're seeing.
Yeah, so it's been a long time since we've had inflation like this, so a lot of people are getting the old playbook out from 1970 or 1980 to look at what performed well last time, and obviously hotels did perform well. I think when we're looking at our business model today, there's a lot of things that are different this time around. One of the things a lot of people has brought up is retail did really well last time because there was percentage rent clauses in the leases. That's not as prevalent today. Most retailers have been able to negotiate that out, so maybe retail won't perform as well as it did in the 70s. But we are certainly focused right now on, because everyone's long-term CPI projections are now above 3. If you build an industrial deal or a new office building and you lease it at less than 3% annual growth, you're actually getting dinged right now on your exit price. And used to, that was a really good thing when you got 3% rent growth, or if it's tied to CPI. So we're rethinking our leasing strategies at both how long we lease, if we do short-term rates or short-term deals today versus long-term, and then do you tie it to CPI, local CPI, national CPI, and what is the correct inflation hedge, because you can actually hurt yourself by not putting in enough annual bumps. So it is rapidly changing depending on which asset class.
Yeah, thanks. And maybe we'll stay on this inflation topic for just a little bit longer. I think it's certainly come fast and furious. The Fed obviously retired the word transitory and stopped using that in earnest. Maybe if we think about just the pervasiveness of inflation, Christy, as you look out there, we're hearing about rent extensions and adding things like CPI inflators into these contracts. But how long do you think this inflation persists, and how should investors be thinking about their real asset portfolios in the light of inflation?
There's a couple of things that I would point to. I mean, I think the house view for us right now is that we expect that inflation will probably persist at a similar rate in 2022, likely abate somewhat in 2023, not normalized to necessarily where you're seeing last 10 years or so. I think there's good reason for that. There is a lot of liquidity right now in the market. We are also obviously seeing inflation coming from the commodity side of things, and that's pushing up really a lot of our expense load. Right now, that's being absorbed. As we've talked about, we're able to pass that on to our tenants. The areas that we invest in also, not daily, but we certainly have some shorter term leases. Most of them are annual. And until that absorption stops, I don't think that we're going to necessarily see any sort of reduction as it relates to pricing. Cap rates, as we all know, have not necessarily reflected some of the changes that we're seeing from the Fed rate, from inflation. And so right now, I think until we start to, again, see some of the liquidity in the marketplace dissipate, our expectation is that there will be some change over the next 18 months, but we'll certainly be in some sort of inflationary market for a period of time.
Good. So one of the parts of that comment there hit on increasing interest rates, right? Fed hiking rates, forecasting more rate hikes as we move forward. Obviously, real assets, by and large, tend to come with a good component of debt financing, so higher interest rates certainly can compress some pricing, provide some issues there. As you're thinking about acquisitions and kind of moving forward with potentially higher interest rates, pursuing or continuing on, what are you thinking? How are you trying to diversify your portfolios and guard against higher interest rates? Jay, maybe I'll start with you.
Yeah, so the beauty of lodging is that it generally has the highest cap rate of any of the property types in commercial real estate, albeit that cash flow is more cyclical than perhaps others, right? We've seen a tremendous opportunity with, obviously COVID affected lodging just like it did most of the other property types, although some held up better than others. But we've seen an opportunity with families, wealthy families that have owned a single asset or two that rode it through COVID, and now they've come out on the other side, and they still believe in the benefits of lodging, but they want to have their interests in a more diversified portfolio. So we have a luxury traded REIT called Braemar Hotels and Resorts, the ticker is BHR, and it's made 2 acquisitions recently. We bought the El Dorado in Puerto Rico. It's a Ritz-Carlton Reserve hotel, and we bought the Mr. C's Hotel in Beverly Hills. And that opportunity, I think, would have largely escaped us if it wasn't for the dislocation that COVID costs.
Anybody want to add to that?
Yeah, I think as Christy kind of said, everyone talks about interest rates, and rightfully so. And there's a lot of talk about that. And in our business, everyone talks about cap rates, but everyone forgets that most people are IRR buyers or total return buyers. And what goes into that is, most importantly, NOI growth or declining NOI. And then secondly, what you're going to sell it for. Interest rates is only one component of that. So with the amount of dry powder on the sideline and the fact that these aren't publicly traded, at least private real estate, it doesn't react near as quickly as everyone expects and there's lots of correlation articles written, but every time interest rates go up 50 basis points, you don't immediately see that impact. There's a 6-month lag, and the market has to price it in. But more importantly, there's all cash buyers, and there's other factors that affect this IRR. And so very few business plans only work based on debt. And so this movement in debt really just, we haven't seen any data comps, at least in multifamily and industrial yet, to know where pricing has moved because of interest rates. So I think it's talked about a lot, but really people don't buy stuff on cap rates. It's just what comes out of if there's below market rents or above market rents, but really IRR is really the more determining factor, and that has a lot of different inputs that affect pricing.
And David, you probably have a unique perspective given the fact that some of your, or most of your activity is in listed, publicly traded securities. So, how much has the market already priced in, and what are you seeing from your perspective?
Yeah, we remain pretty constructive on the listed business. I think, as we talked about, we really feel like, listed real assets, whether we're talking real estate or whether we're talking global listed infrastructure, does well in an inflationary environment, and it does that because, again, a lot of these assets become more valuable as interest rates go up, and so, we certainly saw this. Last year with REITs, obviously they had an incredible year, and some of that was driven by the fact that people were recognizing the advantages they have on inflation. And it goes, I think, to what Jay said about whether you're talking lodging, but even if you're talking apartments or self-storage or assets like that, your ability to increase rents, maybe not nightly like it is on lodging, but monthly. With lease terms rolling over, really does give an advantage to these types of companies. So, we think these companies are well positioned. Obviously, REITs had a great year last year. Global listed infrastructure has handily beat the market in the first quarter, and we really do think that's going to continue.
So let me stop there, see if there's any questions from the audience. The panelists told me we're going to take the entire 45 minutes, so no questions doesn't mean an earlier cocktail hour. So. Any questions? So nobody on this panel came up with this title, but the question was, can you explain fake assets? I'm certainly not going to try to do that, but does anybody want to maybe talk about just some of the attributes that real assets have that other assets out there maybe don't have? I think probably the common thing that people are thinking about right now is a lot of talk around crypto assets, assets that don't have any cash flow, tough to value. So maybe talk about that.
This is kind of more of a general comment, but at the end of the day, right, the people that I talk to investors are looking for income, right? You can take income to the grocery store and you can purchase goods with it. And that's one of the reasons why we like hard assets. They produce a lot of cash flow, and the world's just starved for income everywhere you go. Even with interest rates ticking up, and I would actually question, and I don't know that we at Ashford have a house view on this, but we've been in a 40-year bull market for bonds, right? Interest rates have been, the upper left-hand corner to the lower right-hand corner, and I'm not sure that this whole talk about inflation coming roaring back is necessarily going to prove itself out. We use variable rate debt. Our current cost is 2.86 and we cap it. But we find that generally when the economy is improving, yes, our cost of capital may increase a little bit. But we also find that the other side of that, if we go into a recessionary environment, the cost of our capital goes down. So we'd be seeing a little bit less cash flow during those periods, but our cost of debt would be lowered. And the opposite is true when the economy is in expansion mode.
Any other questions from the audience right now? Well, I think we're talking a lot about the positives of real assets. One of the terms that I've heard a couple of times already is dry powder. From my perspective, that's one of the scariest things that I can think about when we're thinking about allocating assets for clients. Lots of dry powder means people chasing fewer and fewer deals. So help us understand, with all the dry powder out there, how you are thinking about being disciplined in capital allocation. Are there areas that you're avoiding right now? Maybe hit on some of those themes. Well, why don't we start with you?
Yeah, I say this all the time. It's cliche, but capital is a commodity right now. And whether you're pursuing probably the hottest sectors within the private side or multifamily and industrial, and have been that way for many, many years now, office and retail being out of favor of the big four food groups, and then the niche categories like life science and cold storage and data centers have become very popular. But every playing field has lots of offers, multiple offers, from private capital to REIT capital to institutional capital to high net worth capital, and figuring out how to compete and how to make your capital relevant is really what keeps me up at night, and really the hardest challenge in acquisitions. What we like to say is you need to bring capital and expertise. If I'm a developer, everyone's money's green and everyone can help me build a building and everyone has relationships with lenders. I need someone that can help me lease the building, market the building, make smart real estate decisions when inevitable something goes wrong in your development plan. So you're really almost dating, basically. You're having these buyer interviews and you're interviewing not just to bring your money and not just to give them economics, but you're really trying to convince them why to pick you versus the other 10 people that have the exact same economics. And that's a challenge, because there's, as Christy, I think, that there's just a lot of money in the space, and there's really not a lot of places there's not a lot of money. And so you kind of have to pick your battles and where can you be efficient with your capital.
I would just say that on the listed side, I think all that money chasing assets has actually been a benefit. I mean, certainly on the REIT side, I think one of the reasons listed REITs had such a great year last year was because of all the private money that was out there, either taking REITs private or bidding up assets, and I think that certainly helped with the performance. And in contrast to that is the listed infrastructure side, where maybe the capital hasn't been quite as prevalent. Certainly, listed infrastructure does span a number of different sectors, and obviously is a global business. And certainly there are areas where there is a lot of capital chasing assets, but there are also areas, energy and midstream energy infrastructure is a perfect example, right? One of the reasons we're having such issues with commodities and with oil and natural gas right now is because there hasn't been any capital going into these businesses. These businesses have been underfunded, and quite frankly, the businesses have been told by shareholders, we don't want you spending any money. And that's part of the reason why the business is finally working after obviously a very difficult period from 2014 to 2020.
Yeah, I think if I look back on some of the fortune that we've had, but also where we're active now and the shifts that we've had to make. I mentioned earlier in some of my opening comments, one area that we invest in is multifamily, particularly workforce housing. That area has historically been very difficult to get returns to pencil in on the development side. I'll talk a little bit about how we tackle that, but value-add acquisitions are nearly impossible right now if you are looking to try and pencil to a mid-teens return. And so for us, we've had to shift our focus either to core plus, or development. One way that we have tackled the affordable housing crisis and I think tactically also started to invest is through public-private partnerships. So working with the local municipalities, we've actually done quite a few of them here in Texas, and essentially being able to solve a problem that we're all faced with, but still not having to sacrifice return. So throughout these public-private partnerships, we're able to keep rents at an affordable rate. We are slightly regulated, but not big A regulated in that regard, and we're able to share some of the profits with the local municipality. So it's a win-win for everybody. That's an area that we'd like to put more capital to work, frankly, and certainly one that we've shifted or leaned into as the value-add acquisition market has gotten more challenging.
And Jay, you probably have a little bit of a different perspective, given the fact that you're focused on hospitality. There was not a lot of capital chasing hospitality deals for a while there. With the return of travel, both leisure and business, are you starting to see that change, and where are the opportunities there?
Yeah, I think it's really important for an investment manager to know their own appetite, if you will. I'm going to celebrate a 60th birthday up here in a few months, and I can't eat like I used to, right? I mean, I used to be able to eat a large pizza by myself and wash it down with 64 ounces of Coca-Cola and go to bed at midnight. If I did that tonight, it would be a real ugly result. So I think having a differentiated strategy and knowing your own appetite, what can we prudently take in from a capital flow perspective, is important. As an example, this year we'll probably purchase 4 or 5 hotels, and that'll be it. Yeah, people ran away from lodging, and that created an opportunity for all of us. And some of you may find this interesting, but in our luxury portfolio, RevPAR, which is a pretty common metric that people talk about in lodging, which is revenue per available room, we're actually exceeding our 2019 levels already. We've got a Ritz-Carlton in St. Thomas. This is not my budget, it might be yours, but a standard room is going for $2,200 a night. And you can imagine if you have a family and you want to go down there for a week or something, it's gotten very, very expensive. But I think the short answer is you have to know who you are and be careful how much capital you raise.
Great. So if anybody wants a discount, Ritz-Carlton, talk to Jay. He's your guy. So let's maybe the opposite side of this, or at least somewhat related, talking about business travel. Coming back, what we haven't really talked about so far is commercial real estate. We've heard, earlier in some earlier sessions, I think a pretty fairly rosy view on commercial. I'd be interested in this group's thoughts on commercial property, and maybe are there geographically areas that look better than others? Christy, you want to start with that?
Sure. I would say that our sectors are not materially impacted by travel necessarily, and business travel coming back. So perhaps what I would highlight is just, kind of thinking through, I'm trying to think of how I can correlate us to business travel and how commercial is being impacted in the sectors we invest in.
Maybe just commercial property in general, and take business travel off and this work from home and kind of coming back to the office.
What I'm going to talk about is students. I'm not going to talk. So we invest in student housing. I think one area that folks have been quick to make some opinions on is just what they're reading in the headlines and what they read during COVID, and what has actually been the experience on the ground. So this is an area that Virtus has invested in since its inception in 2003. We grew to be one of the largest, 6th or 7th largest owner-operators of student housing in 2015, 2016. A lot of capital came into the marketplace. We opted actually to sell most of our portfolio to some very large sovereign wealth funds, and we didn't re-enter until COVID. And so we have now been quite active in student housing, and the reason that has been is because the market fundamentals haven't matched the headlines. So you had capital that was historically flooding this market retrench, again, mostly ex-US. And what was happening on the ground, especially at the markets that we target, which is tier 1 publics or tier 2 publics with very strong enrollment growth, is that the students weren't going home. They were still staying in this purpose-built off-campus housing. They were maintaining their level of occupancy as you would expect, and the capital that was historically supporting them, was nervous. And so we said, we know this asset class well. We know, to your point, Jay, where we're good. And so we said, you know what, this play makes sense to go back in. So we went back in 2020. We've now purchased, I think, 8 assets within the student housing sector. So a little different than travel and commercial and how we're thinking about that. But again, kind of in the spirit of things are not necessarily as they seem, just based on what you're reading in the Times.
Great. Paul, anything to add on?
We cover traditional office and have been heavy into the life science sector, which is a office use that has to be in. You can't do life science from home. It's really the work from home or COVID is the $1 billion question, and I don't think anyone really knows the answer yet. I can tell you that a market like Bellevue, which is kind of suburban Seattle, has been one of the best performing markets in the country. San Francisco and New York have been very slow. Boston has been a big winner, and then really it's the Sun Belt after that. Dallas, Atlanta, Nashville, Miami. So part of it is geographic. There's no real tie to COVID or blue state, red state. There's really nothing that you can correlate between that. Some of it's suburban's doing better than urban. The one thing I will say that I think could be telling us good signs is the New York apartment market has come roaring back, and so has San Francisco. And that would lead me to believe that the office market will follow, because why else would you live in a small apartment in San Francisco or New York unless you were going to work there? So I do think that, again, we're different in Dallas because we've been in the office the whole time, but when you travel to New York, there's still companies that are just now going back to work, and so we don't really know what hybrid or work from home looks like, because we are not in a post-COVID world in what I would consider most gateway cities and most large corporations. But we're just starting. Google came out today and they're calling the employees back, and Microsoft. So we'll know soon, but it's hard to say geographically, other than the South has done better than the North. But other than that, the correlations are inconclusive at this point. But the important thing, it's the largest asset class, and it's where the majority of Odyssey and NCREIF money is, and no one's selling it because they don't want to take losses. So the question is, what happens to traditional office in pension funds portfolios, because there's not enough self-storage or cold storage or life science or anything else to absorb that capital. So it has to go somewhere, and the question will be, where in traditional office do you want to? Most people are saying Sun Belt, and that's probably a pretty good bet if jobs, helps office.
So let me, go ahead, Jay.
I'll just add one thing from a travel perspective. The business traveler's been the last person to return to the road. So small conferences, 300, 400, 500 people, we're starting to see an uptick in that. But the Microsofts and the Googles of the world, where they would typically bring in 10, 20,000 people to Boston, to McCormick or whatever, that has not materialized yet. So that's kind of the one area that is yet to fully recover.
So let me stop again and see if there's any audience questions. You're not getting out of here early. It's not an option. So one thing we haven't touched on yet, and I know a lot of, at least most of what we've talked about so far, other than St. Thomas, which is lovely, is mostly domestically focused. Just thinking about geopolitical issues, concerns with the ongoing invasion of Ukraine. What does that do? Maybe we'll start with you, David, given the fact that you have a global focus in listed infrastructure assets. How are you thinking about that, and what should we be thinking about 12, 18 months down the road as these geopolitical events continue to unfold?
Sure. I mean, I think the Russia invasion of Ukraine is certainly a game-changing event. I would say that as we came into this year, I was pretty bullish on Europe. I really felt like that it hadn't had the COVID recovery that the U.S. had, and I think some of that was just given how the respective governments had given funds to people. So I think the U.S. was way ahead in terms of the recovery, and I really thought Europe was due for a pickup. I still think that's true from a COVID perspective. Unfortunately, I think that the Russian invasion has really changed things over there. It has definitely created a real energy crisis, certainly worldwide, but especially in Europe. And I think that we have to understand exactly what that's going to mean. And I know the market is hoping, and we're all hoping, that Putin can find some sort of exit ramp that he will be able to get away from and save face and make things sort of go back to the way they were. But I'm skeptical that that's going to happen, because I think at this point he has dug such a deep hole that even if we were to get peace there, I'm not sure Russia's ever going to go back to being treated how they were treated before all this happened. So it creates a huge issue on the energy side. We've all seen our gas and both our gasoline and our natural gas prices go up, but as you all know, it's nothing compared to what's going on in Europe. And we still have a big ongoing issue there, that Russia is a major supplier of both natural gas and oil, natural gas to Europe and oil to the world, and a lot of that gas and oil is not going through. And so I think it's really become the base case that Europe is going to go into recession. I think everyone's hopeful that that's not going to spill over into the U.S., but the combination of the big inflation that we're having that the Fed's going to have to fight, combined with the fact that we are going to have these ongoing hits to the consumer from the much higher gas prices, I think that is going to be a very tough pill for the Fed and the economy to navigate. So I think we could still potentially pull off a soft landing. I think it's going to be much harder for Europe. Now, I do think eventually Europe will work through this. It's gotten priced in to some degree over there, especially in some assets. I'd throw out European airports and toll roads. That's an area, obviously, in global listed infrastructure that we invest a lot in, right? Those assets are still pretty beaten up. They're still not pricing in. At this point, they were starting to price in a recovery. That's really fallen back off. So I think we'll have to watch. I do think at some point they become very investable and attractive. I think they are assets. The world is going to travel again at some point. We will get to the other side of this, but I think it is going to weigh Europe down for a while.
I would say for our business, onshoring is probably the biggest thing that both COVID and the Ukraine, like all the industrial people want not just in-time inventory anymore. So the demand for industrial space has been hugely helped out by the supply chain issues, and Ukraine's only helped that. And then the biggest, problem it's causing is getting materials for construction, whether that's steel or concrete, and it's not just the cost anymore, it's when you're going to get it, because if you're waiting on steel, you can't move to the next part of building your building. And so it's when you're going to get it and the cost that's important to development, and the supply. Everyone sees the boats in Long Beach sitting in the port. All of that kind of onshoring is creating both issues but also insatiable demand for industrial space at the same time. So it's kind of an interesting dynamic.
So I think I'm going to steal a great question that my colleague used in his earlier panel discussion, and that was return outlook for the next 36 months. So maybe we'll go down the line here, and as you think about your portfolio and you plot out the next 3 years, tell us what your targeted return is, expectation, and maybe how much of that comes from income versus capital appreciation.
Wow. This was not in the prepared remarks.
And we'll be asking you 3 years from now to come back.
Is this session being recorded? I'd say 6 to 8%, probably 3/4 of it coming from current income and the balance from appreciation in the underlying assets.
So we have two pools of capital, one that's focused on core plus, and the other that's value add opportunistic in its nature. On the core plus side of things, what I think has been interesting is many of you probably invested in the Odyssey, and you saw very much outsized returns last year. It's lagged a little bit in the core plus side of things. The irony of that is that we all, not all, but probably about 2/3 of us use the same valuation and appraisal firm. So what was interesting for us is that while we would have said we didn't expect the outsized returns that our fund has experienced of north of 20%, which is frankly a little absurd for core plus, it's persisting. And so the Q1 numbers just came in, and we had another very large bump in fair market value, largely driven by multifamily and medical office. So where do we expect it to be? We would like it to be closer to we expect it to be closer to the target return, which is 10 to 12%. And we do think that we'll start to normalize. Our expectations for the last 3 quarters of the year will certainly not be the same as what we experienced in Q1 from an appraisal standpoint. On the value add opportunistic side, it's a 2019 vintage that we're currently deploying. We're coming to the end of its investment period. Right now, what's in the ground is performing well. And so it's going to, at this point, it's projected at over 20% gross IRR. Again, that was targeted. We're actually deciding to take some risk off for the remaining assets that are going into that portfolio, simply because what's in the ground is projected north of that 20. And while we would love to give outsized returns, we're also very mindful of how we mitigate risk. And so we'll probably put some light value add deals in there to round this out.
So from my perspective, if I would talk about listed REITs and global listed infrastructure, I'm still feeling pretty good about both of those. Both of them do have a definite defensive component around them, which I think certainly helps, and some of that's driven by that they both offer pretty good current yield in terms of dividends and sort of the 3 to 4% range, and I think that is what the market wants right now. So I think they will both benefit from that. I think the other thing we have to remember is we are in a much higher interest rate environment. So, if I don't think inflation's going to stay at 7, but if inflation's at 3 or 4, that will certainly help these companies to continue to push the returns up. So, I think a double-digit return annual return is realistic. Admittedly, that's a nominal return and not a real return if we look at where things are at. But again, both of these sectors, one of the things we really like about them is the diversity they offer and the ability to, go where we think where the best opportunities are. Global listed infrastructure is 50% utilities. U.S. utilities are a really good place right now. They're going to grow at 8 to 10% for the foreseeable future. Sometimes the market sort of shrugs that off and says, that's boring, I'm going to go invest in tech. Sometimes the market looks at it and says, wow, 8 to 10, steady 8 to 10% returns, that looks pretty good to me. So I think we're in one of those periods, and so I think these assets should hold up well.
It's a great time to be a stock picker. It's a pivotal moment. The playbook that everyone rolled out in January is now in the trash, and everyone's having to decide what they're going to do. We have buckets of capital all the way from core to opportunistic, and we're really playing the barbell approach of we still think if we are going into a recession and higher interest rates, long-term lease core will outperform, especially with moderate leverage, and all the stuff we've talked about of passing back this inflation back to the tenants. But we also have done very, very well in development, because what happens if we go into recession is all of these buildings that are being talked about won't get built. And if you have the fortitude and the power as a large institutional investor to build all cash or to take on a lower loan-to-value construction loan, you might build the only building in your submarket. And if we do come out of these recessions, as we have quickly over the last few, if you do have the only new building, and whether it's industrial or multifamily or office, you can take tenants out of everyone's building and get top of market rents. So we think that it is a prudent, if you are a long-term investor, when no one else is developing is sometimes when you want to develop, and we think if you can control cost and you can pick the right location, you might be the only person that builds, and then when the spigot turns back on, everyone else is 24 to 36 months behind you, so you have a window where you're the only game in town, and that's a great place to be in real estate where you have pricing power. So we're both taking the core approach to buying long-term leases that would get you through a recession, and then also we think development still has a place in your portfolio.
I think you might have a second act as a consultant. What's the return number?
And the risk-adjusted returns are still pretty good on development. I think that it's core returns are low, and so development returns are higher.
Yeah, I was just going to add that the 6 to 8 that I quoted, that's for our income-oriented products. We are readying, it's not here yet, but a Texas Strategic Growth Fund, $100 million. It's going to be a private offering, and it's going to target low to mid-teen IRRs and invest in some hospitality assets as well as other types of properties, but all based here in Texas. And it's kind of a thematic play on all the growth that everyone's seeing here in Texas.
Well, great. Maybe one last chance for questions from the audience.
What do we do with malls moving forward?
So the question was, what do we do with retail and specifically malls moving forward?
We own a couple malls. They're really changing use is the best way. Everyone's adding multifamily to them. Everyone's adding even distribution. Amazon has bought a couple of malls and completely tearing them down. I think the good thing about a mall is it's usually in a good location. It's the intersection of a couple of highways. It's a lot of land. If you think about a mall on the ring road, there's usually a lot of parking lots where you can build multifamily. Hopefully you're in a good market, maybe for office, universities take them, hospitals take them. So there are a lot of uses. The problem right now in most malls is you don't own all of the anchors. You're still dealing with Sears or Dillard's or Neiman's. And then the second problem is the valuation that you need to do the unlocking is maybe not there to buy them, or the Simons and the publicly traded aren't selling yet. And most of the malls are backed with CMBS debt, which is not the type of lender that will allow you to unlock value. So there's challenges, but I think there's also a lot of opportunities because, again, it's land, and land is done very, very well if you can unlock it. So we've seen some people do very, very well with adding multifamily and office to malls and hotels.
Any other questions?
In order to do that, is there any rezoning necessary for that?
Yeah, so you're playing the city. I think is the easier part of the equation. Frankly, as we've seen, the city wants multifamily, they want hotels, they want office because it's tax value to them and it drives traffic. It's actually the retailers that are tougher. If when you go to Sears and say, we want to build an apartment building where you sit and we'll pay you, they're usually the one that is more of a challenge than the city. The city's usually pretty open because they're losing so much tax dollars when a mall goes dark. So, but they are one of the stakeholders that has to come to the table. But we found most cities realize that it's the center of their city and that they need to invest in it. And so they're usually actually pretty helpful. It's the retailers that I would say are the challenge.
I think it's two malls in Dallas, Valley View and
yeah.
Cotton Creek are doing what we're speaking of right now. And I believe they did have to rezone it, and they have a great project presented right now, to be an example of that.
Yeah, and that would be the greatest example of where Sears blocked them for the long. Sears owned the auto oil changing hard corner plus the actual Sears blocks, and they got in a lawsuit over could you start construction, and that's what has taken Valley View so long. But Valley View is a great example, great piece of land on 635, and it should be something better. It should be apartments, it should be hotel, and because of the retailer, not the city of Dallas, that's what's been the challenge. It's an old catalog company that used to be in Chicago.
That's probably a great place to wrap it up. So please join me in thanking our panelists.